Hey, good afternoon, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick from the Cusick Group. Securities offered by MoneyBlock. It is still March 27th, 2017, final trading week of March, and we have the market right now down, but it's bounced back from its worst levels. Just to give you a quick market update before we get into the strategy that we want to discuss, Dow Jones Industrial down 59. The S&P 500 down 4, the NASDAQ down, or actually up 830. As we had noted, this has been the silver lining of all the indices for the last week or so. The Russell 2000 down almost $4, and you have volatility. CBOE volatility index that is currently trading down now at 1330. So it's come off of its highest levels. It got as high as 1510 was the high of the day. Came off pretty dramatically, so that fear index is pulling back a little bit. But with the market down, what I wanted to do is talk about a strategy that I call the stock repair for stocks that are struggling. This is a pretty straightforward presentation, but one that you're going to have to wrap your mind around, so you can go back and reference this strategy now. This is March 27th, 2017, and we'll be talking about repair strategies for struggling stocks. So how do you actually repair a stock strategy? Well, for example, let's say that I bought stock at $95, as you can see here. It's currently trading at $93.55. Now, what I don't want to do, and I bought 100 shares, I don't want to buy another 100 shares. I already have over $9,500 invested in this. I'm not going to cost average down. That goes against my DNA of putting good money towards bad, if you want to use an analogy of that nature. So if the stock's trading at $93.55 right now, what do I do without adding any more capital risk to this current strategy? And get my break even back up to my break even of $95. Well, I could buy additional shares, right? Buy another additional 100 shares, which will get my at $93.55. That gets my break even to $94.28. But again, I got to put up another $9,000, right, to buy that 100 shares. So now I have $18,000 wrapped up in that particular position. Nope, don't want to do it. So how do you resolve this situation without adding capital risk? Well, this is where the repair strategy comes into play. Let's take a look at buying a long call. So we're going to buy the $92.50 calls. We're going to pay $5.20. Now you're saying, whoa, wait. If you buy that call, Joe, for $520, $5.20, you're adding capital risk. You'd be completely right. But what I'm going to do is I'm going to sell two of the same expiration month, but a higher up strike, the 95 calls, which happens to be my break-even point, and I'm going to collect $3.80, or in other words, $760 for selling those two contracts. If you look at it, I'm actually using these calls to pay for this call, right? 760 minus 520, I have basically $2.40, right, of profit. In other words, I am now going to be reducing my cost basis by that amount. So when you take this 380, that's 760. You subtract 520 from there, you still have $2.40 left over, which means that now not only am I getting into this call spread for free, I'm reducing my cost basis on my stock by $2.40. So now I own the stock for $93.60. Let's talk through this a little bit. Remember, at this point, I bought one of the $95 calls for $520. I sell the $95 calls for $380 two times for a credit of $2.40. Our new break even now is $92.60. 95 minus 240 is $92.60. Remember, the stock is trading at $93.50, so I'm actually now lowering my cost basis below where the stock is trading. Right? So now the cost basis of the stock that I bought originally at $95 is no longer at $95. It's at 95 minus 240, which is $92.60. So now my cost basis is actually back below where the market is trading. Now someone might jump in and say, well, wait a minute. You sell two calls here and you buy one there, Joe. You are naked short calls. I'd say on the surface, you might be correct, but remember, I own 100 shares. So I'm actually selling this call that's being covered by these 100 shares. So I have one long call, I have bought 100 shares, which is my core portfolio, and I'm selling 2 of the 95 calls. And I'm using the proceeds to pay for these calls and offset my cost basis in this case by the remainder of the credit that's still left over. So now I've done 2 things. I have a free call spread, the 92, 98, 95. That means that I can make $2.50 to the upside, right? It also means on the call spread, so I own that for free. I'll make the $2.50, actually $3.50 on the stock, right? Because I stopped making money at, or $2.50 on the call spread, $2.50 on the stock that I own, which basically means that I'm going to make $5 on this position, where if I did nothing, I would just be break even. If the market just sits there, at least I reduced my cost basis to $92.30, right? So if the stock stays at $93.55, I still have $1 profit. I could sell out the stock if this spread goes out worthless at expiration. What are the drawbacks though? Profit's limited. I'm limiting my profit to the short strike price, which is 95. But I'm willing to do that because statistically, let's just say that there's less than a 30% probability that it's going to expire between now and expiration above that strike prices. You won't realize your complete break even right away. In other words, you're not going to realize that $92.30 on the until expiration. Okay? Other ways that you can use this, it enhances the free call spread. You could sell it for a credit, right, which is cost basis reduction, which we showed. Now, some of you might say, well, Joe, but I don't own 100 shares. What are some of the other things that I could do with that? You could use longer-term options called leaps. This is something that came up on the floor of the CBOE way back in the day, right before I went on the floor as a trader. But you can use the in-the-money leap as a proxy for the stock. That's a longer-term option that has about 10 to 12 months or up to 24 months until it expires. And then we'll sell out-of-the-money calls with a free call spread built into it. Let's just build out this real quick, and then we'll recap the markets. So instead of buying stock, the stock's trading at $25.65. Instead of buying stock at 100 shares at $25.65, maybe I have a small account. Let's say $5,000. So instead what I'm going to do is I'm going to buy the January 1 year out, so it's 12 months, $22 calls, and I'm going to pay $5.55 or $555. Now what I'm going to do is I'm going to look at the closest expiration month, right around 40 days until expiration when I started looking at this. Let's say June. Okay, so I'm going to buy the June 26 calls. I'm going to sell the June 27 calls. I'm going to buy one and sell 2. So that means that I'm going to pay $133 for the 26 calls, but I'm going to sell the 27 calls for 72 cents 2 times, so collect 44 cents. So 113 minus 44 is 31 cents. So I have 31 cents that will reduce my cost basis. So now, not only do I have this $1 call spread on for free, but I also reduced my cost basis on the $22 calls I purchased by 31 cents, the remainder of the premium. And so now my cost basis between now and June expiration on this particular $22 call is $5.24. So now I only have $524 worth of risk in this whole net opportunity. If the market goes up from 25 to 27, I'll make $1 on this call spread plus the capital appreciation on this long-term option. This basically means, folks, that now I have a position where I have right around $500 worth of risk for the next year. I have profit potential of roughly right around, if you take 5, so basically probably around $2.50 to $3 worth of profit potential for the next 40 days on $500 worth of risk. That means that if you did one contract, and you made $3, you basically are almost, and you make, let's say, $2 on this, $2.50, you're basically making a pretty decent return on what is not a significant amount of money as far as your position's concerned. So this is how you can go in and say, well, I've lowered my cost basis now, where my break-even's $26.05. I could make up to $169, or around 32% on the risk capital that I have in this particular position, all by just buying a long-term equity option that has about 9 to 12 months before it expires as a proxy to the stock. It's in the money versus where the stock is trading, right? And then I'm selling the ratio spread, where I'm buying one call that's in the money versus where stock are right at the money, and I'm selling a call that's slightly out of the money, and I'm doing that on a ratio of 1 to 2. And I collect a little extra premium, which reduces my cost basis, lowers my break even. And so basically all I need to do is have the conviction that the stock is going to be at or right below $27 between now and the expiration of this call spread. And folks, you're doing this very conservatively. All right. As always, if you ever need to get a hold of me, you can always email me at jcusick@moneyblock.com, or you can email MarketStream.live and just info@MarketStream.com. That's info@MarketStream.com. All right, we will be back at 3:30 Eastern Time for some tech talk. We'll be wrapping up some cool stuff about earnings. We've got some big names that are going to be coming out this week, as well as just give you some general ideas about where the market is and where the forecasts are of it going. We'll see you then, 3:30 Eastern Time, MarketStream.live.